Hi everyone, and welcome to our first live Q&A of 2026. Thank you all for joining us today. As always, if you have any questions at all, you can already type them up on the live chat box on your right-hand side of the screen. And today we do have a list of pre-submitted questions from you, which our expert Brad will help answer. Before we begin, my name is Leah with Sense Financial, and we are a boutique financial firm specializing in self-directed retirement accounts with checkbook control. I briefly want to introduce our speaker for today, Brett. He is a solo 401k and SDRA consultant here at Sense Financial. He has a professional journey spanning over 18 years in real estate investing. Brett is also a licensed California real estate agent, and his passion lies in empowering people to attain financial independence, affording them the possibility of an early retirement. And so, all right. Hi, Brett. Thank you so much for joining us today. You have a couple of words to put in before we start with our questions.
All right. Yes, not going to put in too many words up front because we do have quite a few questions and some really, really good ones that I personally am looking forward to answering and digging into. There's a few of you that have already taken advantage of the chat. Please continue to do that. In the event, we do plan to go an hour today. In the event that we are unable to get to all the questions, we'll do our best to circle back around with people, assuming we have your contact information, and reach out directly and get those questions answered. If you don't hear from us in a day or two, it's because we don't have your contact info. Just jump on our website, SenseFinancial.com, and click on Schedule Consultation. Get on my calendar, and we will have a quick chat about whatever it is that you want to chat about related to self-directing retirement. And yes, Happy New Year, everybody! Without further ado, let's dig in.
All right. Our first question for today is from Bill. How does the 5-year rule apply to a late December end of the year solo Roth 401k conversion? If the employee notifies plan custodian on December 30th, 2025 and is accepted, but the title of the asset is not changed till January 2026, is year 1 2025 or 2026?
Okay, well, there's a lot there, Bill. You have one very specific question, but I'm going to give a little bit of context here because it's very possible that there's people on this call or maybe watching the recording later that are confused by what you're talking about. So, Bill is has a solo 401k, and he's asking about doing a Roth conversion of an asset. This is also known as an in-kind conversion, in plan, in kind conversion. In kind means that the asset is not being liquidated first, it's not being turned into cash and then converted, which you could do. But what Bill is actually doing, or what he clearly sounds like he already did, is he's converting an actual asset from traditional pre tax to Roth. Of course, Roth is you pay taxes today, no taxes at distribution time. Traditional, you reduce your tax liability by making the contributions today, and you pay taxes um, when you distribute the assets to yourself, the cash, whatever it is, down the road, right at retirement time. So that's the difference between traditional and Roth. Now, Bill is asking about the conversion. When you do a Roth conversion, they each conversion for each year has its own 5-year rule. And the 5-year rule when it comes to Roth contributions is the first year you make your first Roth contribution, IRA and 401k are separate. Roth IRA, Roth 401k are separate. If you have if I make a Roth IRA, if I make my very first Roth IRA contribution today, all my Roth IRA contributions in the future will be affected by the 5-year rule for the first Roth contribution I made this year. And the dates always revert back to January 1st of the tax year of the contribution, or in this case, of the conversion. But let me finish up my thought on the contributions and the 5-year rule and how it works. So the 5-year rule says um, I can't distribute the principal to myself or a distribution of gains or both before the 5-year period without incurring taxes and penalties. It doesn't matter if I'm over 59 and a half. Again, once the contribution, the very first year I make the contribution gets past 5 years, in this case, January 1st, 2031, all subsequent Roth IRA contributions will be already past the 5 year rule at that point, okay, after 2031. All right, that's how the 5 year rule comes into play when talking about contributions. And it works the same way with Roth 401k. But again, the 401k funds are tracked separately from the IRA funds. Okay, so they have their own 5 year rule when it comes to contributions. Now, when it comes to conversions, they are not kind of quote unquote grandfathered in, if you will. They are actually um, they actually have their own 5 year conversion. Excuse me, 5 year rule. So the clock starts for Bill. He's asking. I'll come to the title change here in a moment. I assume you're probably talking about a piece of real estate. And so let's say you did the conversion in December. The conversion took place in 2025. That means the 5 year clock started on January 1st of 2025. When the title changes is a separate conversation. You should change the title of the asset as soon as possible, but that's not when the actual conversion took place. Okay, so uh, January is most likely the answer to your question here. It's really the simple way to think about it is what year are you paying taxes on the conversion? If that's the 2025 tax year, then that's the answer to your when your 5 year clock started. Now, I do need to clarify something here because your question says if the employee notifies the plan custodian. Well, you may not be our client because with our solo 401ks, you have checkbook control and there is no custodian. You are the client, the plan owner is actually the administrator of the plan, the trustee of the plan, and that's what gives them checkbook control. There's no custodian to notify or report to or go through or anything like that. In fact, you don't even have to go through us at Sense Financial when it comes to doing something like this with your solo 401k because we're not a custodian. You control all of it, right? And when you do this, of course, it's a taxable event. So discuss with your CPA what that looks like before going down that path. Hopefully that answers the question. Let's move on to the next one, Leah.
The next question is from Kathy. She's asking, what are the changes we need to know about concerning self-directed 401ks for this year?
Oh, great question, Kathy. And actually, for this one, I am going to share my screen because I want to make sure I keep myself on track because there are some changes and I haven't quite internalized all of them yet, although I will. Let me do this. Okay, I'm going to look to my left while I'm answering these questions. So bear with me here. Okay. So this is actually an email we sent out to our database a few weeks ago, maybe a month or so ago. And basically, you have the 2025 limits on the left, and then you have the 2026 limit on the right. And as you can see, the limit for traditional and Roth IRA contributions went up by $500 from 7,000 to 500. Okay, or from 8,000 to 8,500 if you're over 50 and you take advantage of the catch-up contribution. And then for the, excuse me, I stand corrected. This is why I have this up. The traditional IRA catch-up contribution has been $1,000 and it just went up to $1,100. So now it's $8,600, not $8,500. I stand corrected on that. Okay, so the change was $100. The 401k employee contribution went up by $1,000, which is awesome, from 23,500 to 24,500. And then the catch-up contribution went up by $500. So instead of 7,500, it's now $8,000. Okay. And then the catch-up, the super catch-up is still a thing. It's 11,250 for the years that the 401k owner turns 60, 61, 62, or 63 in. If you're outside of those, you just get the regular catch-up contribution, or of course, if you're under 50, you don't get the catch-up contribution at all. And there were some changes to HSA Incidentally, this is outside the scope of this, but we will be offering, Lord willing, before this year is over, self-directed health savings accounts. Looking forward to it. We're not quite set up to do it yet, but just look out for more on that. Now, there is a change on the employee contribution where if you pay yourself a W-2, so here's the total limits, right? This is under 50, 72,000, okay, went up from 70. And the catch up is up, gets you up to 80, or with the super catch up, gets you up to 83,250. Okay. By the way, if you're married and both spouses participate in the plan, these numbers double. So you can literally put in over $160,000 a year in a 401k if there's enough income in the business and if both spouses are participating. So very powerful. Um, so here's the change I was talking about. As a W-2 employee, okay, this is S Corp, C Corp, okay, not sole prop, not partnership, not LLC filing as a sole proprietor. If you're a corporation, you're running payroll, you're a W-2 employee, if you pay yourself over $150,000, then you're considered in 2020. I think that actually might be no, it's in 2025. Then you are considered a higher paid employee by the IRS, and your catch up contribution must be made as Roth. Okay, so that's the 8,000, or if you're doing 25, um, actually, no, that's starting 2026. Excuse me, not 2025, but they're looking back at your 2025 W-2 income to begin this process. So if you paid yourself $145,000, then you can do it as Roth or traditional. Okay, so that's the one kind of nuance, sort of strange change, if you will. It's part of Secure 2.0, but that's what that is. So those are the major highlights of what changed this year. And great question, really appreciate it. And we can move on to the next one. But thank you, Kathy, for that question.
The next question is from Robert. He's asking, can I buy a self-directed 401k property I own through or from a personal self-directed IRA LLC?
Oh, Robert, great question. You are a disqualified party to your retirement accounts. Okay. Your retirement accounts cannot transact with each other either. They can invest together. That's a separate conversation, but they cannot transact with each other in this manner. You could, if you're eligible to do this, assuming you qualify for solo 401k and it's a traditional IRA, not a Roth IRA, then you could do an in kind transfer, direct rollover from the IRA to the solo 401k. So that would absolutely work, and you're accomplishing literally the same thing. It's not a buy or a sale or a purchase; it's a transfer. It's a direct rollover. You can roll over assets other than cash, right? Any asset can actually go from one IRA to another IRA, or from an IRA to a 401k, with the exception of Roth IRA. Once Roth IRA, always Roth IRA. Okay, that's the one exception. So that should answer your question, Robert. Great question though.
Mitzi has a question about the LLC that they formed in creating a self-directed IRA. They're asking regarding the legal parameters of the self-directed IRA. This question isn't too specific or clear, but maybe, Brett, do you have an idea?
Well, I mean, I can talk about the LLC in general terms. Mitzi, if you have a specific question and you're here, feel free to type it into the chat. If not, I will try and personally reach out to you later about this. But the LLC is what's called a special purpose LLC, which means the operating agreement is specially written so that it's IRS compliant, so that you can have checkbook control over your IRA. You are what's called a non member manager. That's how you have checkbook control. You have the manager level control over the LLC, not the IRA, the LLC. The only member of the IRA of the LLC is your IRA. It's 100% of the owner of the LLC. You're the manager of the LLC. Again, you're a non-member manager. You are a disqualified party to your retirement account, you and your immediate family. You can't transact with your retirement account, as I was talking about earlier. You can't personally benefit from something that the retirement account is investing into, not directly or indirectly. Yes, it's your retirement account, it's for your future. That's not what I'm talking about. I'm not talking about distributions down the road. So the operating agreement is written with all of this detailed out inside of it. Okay, and so that's how it's written. Now, you're saying, Mitzi, the LLC I formed, so that's that you formed. So maybe you did this on your own, or you're just talking in general that you have an LLC, an IRA LLC. I'm not really sure, but but if you have specific questions, I'm happy to address them. But that's kind of my general answer to the way the IRA LLC works.
All right, the next question is from John. He would like to know what is our Soul 401k initial and maintenance cost?
Oh, yes, very straightforward. One thing you'll realize is that we do things as simple as possible. And one of those is flat fees. We have no asset based fees or anything else. So they're just a startup fee, a setup fee, and an annual maintenance fee. The first year annual maintenance fee is included in the setup fee. The setup fee is $800. The annual maintenance fee is a flat $250, and that would be first charged, yes, in the setup fee, but the first $250 charge would come in year two. Okay, so $800 gets you the first year, and then $250 after that, and then we have no other fees at Sense Financial. And bear in mind that these are business expenses. Your business, your self-employment is what qualifies you to have a solo 401k. So the expenses related to that plan are tax write-offs. All right.
John is also asking, does the Sense Financial Soul 401k have the ability to do Roth employer portion, pre-tax employee portion, and mega backdoor Roth annually to maximize retirement funding benefit?
Yep, great question. Our solo 401k adoption agreement allows for three buckets. As you mentioned, the employer or profit sharing contribution, the employee or elective deferral contribution, as well as what's called an after-tax employee contribution, which is where the mega backdoor Roth comes into play. So you make an after-tax employee contribution once you get past the limits of the regular type of employee contributions, which I just went over. 23,500 for 2025, 24,500, up $1,000 for 2026. Once you get past that, if you want to make more employee contributions, you can do that up to the maximum for 2025, all the way up to $70,000. When you do that, it's an after-tax contribution. So it's not tax deductible. And then you immediately convert it to Roth. That's the mega backdoor Roth. So yes, John, to answer your question, our adoption agreement includes all of that.
And the final question from John. Do I have the ability to personally or get others to invest in conjunction with the Soul 401k funds?
Yes, absolutely. Well, personally, would be something you'd need to be very careful with. As I mentioned, you cannot, well, I didn't say this part. You cannot enable your retirement account, so you need to be careful with that. Basically, the retirement account should be able to make the investment without you. Okay. Now, I'm not a CPA, I'm not an attorney. None of what I'm talking about today is legal advice or tax advice or contract advice or anything else. Just this is just educational only. So consult a CPA or an attorney before you go down the path of quote unquote partnering up with your IRA or 401k. Now, you could do what's commonly known as a fractionalized loan, where somebody else is putting in $20,000 and your 401k is putting the other 20. It's the same borrower, but two separate payments are going out, one to you, one to your 401k and one to that other person, third party. So can you personally get involved? Yes, but you need to keep things as separate as possible. So, for example, if you're going to use your 401k to invest in a syndication, a real estate syndication, um, your 401k and you cannot be part of the same paperwork. Okay. You can't like split the K1 that comes out. Everything needs to be separate. All right. In that case, you could invest together, but it's really just into the same investment opportunity. So we can talk more about that offline if you have a very specific example that you want to run by or a scenario. But best to just keep everything third party from you and your immediate family.
The next question is from Kimberly. Do clients have to use the banks that you recommend?
Oh, Kimberly, this is actually a common question that comes up. Well, so there's a couple things going on here. When we set up a checkbook IRA, we're not a custodian, so we use a third-party custodian called Solera Bank. Now, that is the custodian for all of our IRAs. I shouldn't say that. Most of our IRAs. That is where we set up the IRA right now and have for the last several years. Okay, we have some clients with, um, another custodian possibly, and they've moved over to us, or we set them up originally many, many years ago before we were partnered up with Solera. But Solera acts as the custodian for all of our IRAs right now, the new ones we set up. The Solera is also a bank. So simultaneously, while we set up the checkbook IRA, the LLC, for example, the Solera will also open up a checking account. This checking account is the home for the money until you invest it, whether it's a contribution or a rollover. Um, and this really goes for the solo 401k as well. During our setup process, we open a checking account on behalf of the solo 401k. You have to finalize it. We start the process, you finalize it because you have to verify your identity and such with the bank. Once all that's done, you have this checking account in the name of the IRA LLC or in the name of the solo 401k. And then you can move money into it, whether it's by a contribution or direct rollover. And then you can self direct from that checking account. Do you have to use the bank for the custodian? Yes, because that's what we do as our setup. As far as the bank, if you want to open an account at another bank, you have the power to do that as the manager of the LLC for the IRA or the trustee of the 401k. You certainly have control to open an account wherever you would like, wherever you can. The reason we partnered up with a bank like Solera is because they specialize in self-directed retirement checking accounts. So we get zero pushback. The client has zero uphill battle when opening this account. If you walked into your local credit union or Wells Fargo, it would be a mixed response. Mostly, you would just get met with, "What kind of account are you trying to open up? We can't do this." Now, there's some exceptions to the rule. You can certainly, people have successfully opened solo 401k accounts or IRA LLC accounts at other banks. It's just not going to be a predictable, smooth process like it is with Solera. So that's why we partnered up with them. It's why we recommend them. And that's why they're built into our establishment process, because we have access. Furthermore, we actually have access to their management team. So if there's an issue or if we need to talk through something, we have direct access to them. We don't have access to all the banks in the country. So if our client chooses to go somewhere else, they're more than welcome to. Um, but we can't predict the outcome, and we can't help them because we don't have access to those people. We can kind of help them indirectly by helping them understand what kind of account they're trying to open, but we don't have access to that bank like we do with Solera. So that's why we use Solera. Um, I wouldn't use the word have to. That's not proper because as for everything I just said. But just to add one more thing, Kimberly, it's not a good idea to use the same bank that you already bank at for your solo 401k or your IRA. Why, you ask? I'm glad you asked. Here's why. Because the chances of commingling funds increases astronomically. If I'm doing a mobile, actually, I have multiple accounts at Wells Fargo, a few personal accounts, and my business checking account. Okay. My so when I do a mobile deposit, it asks me, the Wells Fargo app asks me which which account I want to mobile deposit this money into. It's the same thing if I do a Zelle. If I Zelle money from my Wells Fargo, it's asking me where that money's coming from. If I accidentally choose the wrong account, especially well, the deposit for sure, then you just caused yourself a big problem, especially with the IRA. So it's really best to just keep it separate from your personal situation, since it really is somebody else's money that you, as the fiduciary, are managing. It's not your money, it's the IRA or the 401k's money. Until you take a distribution from it, that money is not yours. Okay. So I just want to be clear about that. Do you have the power and the control to open an account wherever you would like? Yes. Do we recommend it right out of the gates? Absolutely not. It's going to cause you some pain during the setup process that you can easily avoid. So, anyway, I'm off my soapbox on that. Good question, though. I really appreciate it.
Thank you, Brad. The next question is from Marilyn. She's asking, what is Solera's role in regards to RMD distributions when the distribution is being made from my account, not at Solera?
Oh, hi, Marilyn. Thank you for the question. Well, Solera, in the event of an IRA, would be your custodian, the IRA custodian. All distributions have to go through the custodian. Okay, so that is their role. You can't do it on your own. You can't take it directly from the LLC. You have to say to Solera, and they have an online form you can fill out for taking a distribution. And you would say, hey, I want to take a distribution of X amount. Here's the account number information, and is it RMD? Yes or no? And then they'll process it because they have to issue a 1099 as well. But the money has to move from the LLC into the IRA account first, and then they can process the distribution by wiring the money to you or ACH or sending you a check. They do have a $25 flat fee for the actual distribution and no extra fees if you do an ACH or check. It's free, but if you do a wire, then they have an outgoing wire fee. But that's why. And incidentally, the custodian for the IRAs, and this is the same at Fidelity, Vanguard, whatever. They're there first of all because by law they have to be. Also, for contributions and distributions and Roth conversions. Okay, those are essentially the three common reasons that the custodian would get involved in a checkbook IRA situation. Now, Marilyn, if you're asking about a solo 401k, that's a separate conversation. There is no custodian. You have the power to process the distribution yourself without Solera directly being involved. Now, if the checking account is at Solera, like many of our clients have, then you'll take the distribution from that checking account. But Solera is not involved other than just being the place where the money happens to be held. Okay. So there you go.
The next question is from Sento. What are the do's and don'ts of investing outside of the US as a joint venture?
Um, well, I would just say this because I can't advise on this. I would say have an attorney or a CPA on both sides of the border and consult them about this.
All right. The next question is from Virginia. I have money in a company 401k. How do I transfer that to something that I can access and use in a more efficient manner?
Uh, Let me back up to Senthil a little bit because I was a little bit, forgive my candor. Uh, the same rules apply that apply inside the US as far as the disqualified parties prohibited transaction rules. At the end of the day, it's still your IRA or 401k that you're doing this with. So the same rules apply. Okay. So look at first, get comfortable with that. and then consider. Now, when somebody usually asks me about investing outside the United States, it's typically because they want to have some kind of personal use of the property. And so, like 9 out of 10, if somebody doesn't know about the disqualified party prohibited transaction rules, they are wanting to buy a home in, like, I don't know, Brazil or something, and then they want to use it like during the summer personally. And that doesn't work, right? Again, you're a disqualified party. You can't go stay at the property the IRA owns. It's for investment only. It's all third party. So those same rules apply. If you want to later distribute the real estate to yourself once you turn 59 and a half, you're welcome to do that. In fact, we have a lot of clients that do that in their Roth, especially because then they can distribute the property to themselves tax free. But that applies inside the states, outside the states, whatever. But I think my best piece of advice is what I originally said, and that's get advice, legal advice on both sides of the border before you do that. All right.
Thank you
So
for that, Brad.
thank you. Yeah, for sure. You don't need to repeat Virginia's questions. So I appreciate it.
All right.
Um, all right, Virginia. So money in a company 401k. Well, if you were on the phone, you and I were having a one-on-one conversation, I would first ask you how old you are. Um, because this sounds like a current employer. Once you turn 59 and a half, you can roll the money out to another plan. Before you're that age, you probably won't be able to. You might be able to. The question to ask is of the plan administrator, can I do an in-service rollover of any type? Now, if they let you roll over money, it's typically only going to be before 59 and a half, it's typically only going to be the contributions you made, not a match of any sort. Okay. So that's usually going to be stuck there. The other exception would be is if you rolled money in from a former employer W-2, that money can always be transferred out. It doesn't matter if you're 20 years old or 49 and a half years old or 58 years old. It doesn't matter because that wasn't that company's, um, it wasn't under that company's original sponsorship to begin with. So you can always do whatever you want with that. So ultimately, Virginia, ask the question of the plan administrator, can I do an in-service rollover? If they say yes, say, how much? What's my maximum? And then find out. And then you could transfer it to an IRA or another 401k at that point.
The next question is from Joseph. I am 61 years old. Can I take a one time distribution from my self directed 401k?
Joseph, you can take a one-time or a thousand-time distribution. Once you're 59 and a half, it doesn't matter if the self-employment is still in place. You can take distributions from your solo 401k, whether they're Roth or traditional. Obviously, is going to change how the taxes work on distribution, but absolutely not a problem. One time or a thousand times, it's totally up to you. Just discuss with your tax advisor before you start adding to your taxable income.
The next question is from Bobby. I have done payroll for employees before, so I understand the process. I want to know what is the simplest way to set up payroll for just myself as a sole proprietor business in order to make a larger annual contribution to the self directed plan.
All right, Bobby, thank you so much for the question. Well, the only reason that you would have to set up payroll is if you're a corporation or you have a corporation. Um, if you don't, you said sole proprietor, so there's no payroll requirement for that. So you can discuss with your CPA, but most people aren't eager to pay a bunch of payroll tax, FICA, Medicare, et cetera, if they don't have to. And you don't have to all business types have the exact same contribution limits for a solo 401k. It doesn't change anything. Now, the way the contributions work are different. For a corporation, it's going to be based on the W-2, and the employee contribution has to be run through the payroll and reflect on the pay stubs, et cetera. But as a sole proprietor, you're just doing this based on the profit of the business. I wouldn't set up payroll personally. I wouldn't set up payroll if I don't have to. So hopefully that answers your question.
Our next question is from Donald. I have a checkbook IRA with Sense Financial. On your checklist, it says that the annual valuation is a total of all the assets. Just to confirm, if I invested $50,000 in a RE syndication and I have $10,000 in my trust checking account, the total valuation would be $60,000.
Well, Donald, at Sense Financial, we can't advise specifically on what the valuation is. Um, Let me just say this: the valuation, either the 5498 for an IRA, which you have, thank you for being a client, by the way, or a 5500 EZ form if it's a solo 401k, is not a taxable event, right? It's just the valuation being disclosed to the IRS. If it's taxable, obviously you need to go out of your way to involve third parties from a valuation perspective, especially if it's an asset like a syndication and not just cash sitting in the plan. Before you do any sort of Roth conversions, which is a taxable event, or distributions of an actual asset in kind distribution, like we talked about earlier. But when it comes to the this example of the annual valuation, that's probably okay. You have two other options. You can get it off the K1, or you can reach out to the operator of the syndication and say, "Hey, what's the market value of my $50,000 investment in your operation?" So those are essentially your three options.
All right, and our last pre submitted question for today is from David. Do I have 30 or 60 days to move my funds from a non IRA account to my IRA?
I assume, David, that you're asking about an indirect rollover. We don't at Sense Financial recommend those, just because they can become a distributable event and you can incur taxes when you don't intend to. But the rule is 60 days. It's a 60-day rollover. So I assume that's what you're asking about. You took money out of a retirement account, an IRA, um, or possibly a 401k, and you're wondering how soon you have to get it into a plan. Um, we definitely don't recommend this with a solo 401k because there's no 5498 that's issued to reflect the indirect rollover that it was an actual contribution. It's a little easier to do and prove to the IRS that it was an indirect rollover and it definitely went into the plan before the 60 days or by the 60 days, because of the 5498, which again, you just don't have with the solo 401k. Talk to your tax advisor about this. There's very rare, I can't even, I mean, I can think of an example. It's just when somebody comes to us and they already took the money out of their plan, would we ever recommend an indirect rollover? But anyway, that's kind of how that works. So hopefully that answers your question, David. Thank you.
All right, we'll now go ahead and go through the questions that we have on our public chat today. The first question that is live from today is from Sam. Can I do options for my Silver K account, and is there any constraint on what options I do? I will not be doing on Margina, and I will just be selling cash covered puts and cash covered call or covered calls.
Yeah, margins is what that says. Margins would be borrowing money to do the investing in the stock market. That would um, likely trigger a UBIT tax, unrelated business income tax. Um, the Actually, not likely, like I'm almost sure it would. The Could you do options in your 401k? Um, Possibly. I would check with your CPA, because the solo 401k is designed, and same with the IRA, is designed to be invested passively. Okay. Could you do it? Sure, you can do it. Is it passive? Not really. Is it going to trigger unrelated business income tax because you're, quote unquote, running an active business inside the plan? I mean, I'm not a day trading expert, but it seems to me that trading options is a form of day trading, which one could argue is an active business. So check with your CPA because I'm not 100% sure. But I can tell you it's not necessarily what the IRS has intended with 401ks and IRAs because it's not exactly a passive activity. Okay. So, yeah, that's what I got on that, Sam.
Ven is asking, they need guidance on issuing a 1099-R for our solo 401k. This is our first time.
Yeah, I'm going to share my screen again. We have what's called our client portal, and our client portal has a lot in it, including a knowledge base, by the way, which has about 17 pages of different articles that you can search by keyword. Maintenance in the plan has the 5500 instructions, literally line by line instructions on how to fill it out, not difficult, how to file it, etc. The 1099 instructions, same idea. So then log into our client portal, which you already have access to. Thank you for being a client. And then go to maintenance form 1099 instructions, and then just scroll down for your applicable reason why you're filing a 1099. Okay, so much of this is like general information, but why are you applying it? So let me see if your question says why. Let me see. Hold on. Need guidance on issuing 1099-R. Yeah, you don't specify then why you need the 1099-R, but basically, um, just go in here and scroll down until you see your specific reason for needing 1099. Okay, they're all in here. There's not one that's missing. Okay, so just scroll down and follow the instructions, and that'll walk you through. All right. So if you're not a client, you just got a preview of our client portal, which is cool. I'm going to keep going here. It looks like Leah had some technical difficulties. Let's see. Joseph is asking, in addition to separate bank accounts for employee versus employer, do I need to maintain separate investment accounts for employee versus employer? Example, Fidelity or precious metals. Um, I mean, you could. It's not 100% necessary. Here's the simple way to think about the bookkeeping aspect of this, because yes, the contributions are treated differently. You can take the elective deferral out sooner than you can take the profit sharing contributions out. For example, obviously Roth traditional is another prime example of this. You didn't ask about that, but it's part of this as well. Um, if you have, in fact, let me use Roth traditional as an example because that's going to make more sense to people if they're not super familiar with a solo 401k, and just replace employee and employer with Roth traditional because it's all kind of the same explanation. If you have $50,000 of traditional and $50,000 of Roth, and you want to combine them into the same precious metal investment inside the same solo 401k plan, you can absolutely do that. Remember, the plan is the investor, not the individual type of funds within the plan. Even if you have a Solera checking account and you have the main relationship with the bank is the solo 401k, let's call it the Joseph 401k plan. Now, you can have as many checking accounts underneath that umbrella, that relationship with the bank, as you want. And then you can even rename them. For example, if you want to keep track of employee, employer, Roth traditional, just change the name from checking account 012 or whatever to Roth or traditional or employee or profit sharing. It's up to you. You're the plan administrator. You keep track of this stuff. Now, if I want to take 50,000 traditional, 50,000 Roth and invest it all into gold, you can do that. The account with the gold provider, the gold exchange, whatever it is in the name of the Joseph 401k plan and its tax ID number, not you and your social. And the money comes from the checking account and goes to that person and buys $100,000 of gold. Well, you know that it's 50-50. You can figure out the percentage and just treat it pro rata during the entire life of that investment. So if you liquidate that gold and instead of $100,000, it's now worth $200,000, well, $100,000 goes back to your Roth and $100,000 goes back to your traditional. So just keep track of it from that perspective. You can do the same thing with Fidelity. If you wire $10,000 or ACH rather $10,000 of pre-tax funds into Fidelity and $10,000 of Roth, and you invested in the S&P 500, it's 50-50. Okay. So you can keep track of this at the account level by separating all the accounts, as you mentioned in your question. And or you can keep track of this on a simple spreadsheet. Okay. Personally, it's probably not a terrible idea to do both, especially when it comes to Roth and traditional. But you don't have to do that. You can, as I mentioned, you can combine the two, especially in the solo 401k plan, because it has Roth and traditional built into the plan, profit sharing and employee rather built into the plan, and it can all just be invested together. Okay, so thank you for your comment, Joseph. I see that you understand, so I appreciate that. Let's see. I have to scroll back up because when somebody adds a new comment, it like moves all the chat down to the latest comment. So bear with me here. All right, now Sam is asking, my solo 401k plan is 50% partner in LLC that owns 50% of two real estate assets. Okay. To allow for flexibility, we are transferring the assets out of the LLC and to the solo 401k. All right. And the other partner, so as to allow for flexibility of each party's 1031 options. Okay. Is there any issue with transferring the real estate assets out of the LLC and to the solo 401k trust? As long as it's not Roth IRA, then, excuse me, you said my solo 401k, not my IRA, owns is 50% partner in LLC. No, there's no issue there. If the provider is willing to do that, then that's fine. Yeah, as long as it's not involving you or your immediate family, then I see no issue with that. As far as like the structure of the plan or the legalities behind it, check with a lawyer or your CPA, but there's no issue at the 401k level with doing something like that. So yeah, no problem at all. All right. Bob, we answered all the questions. Oh wait, never mind. Looks like you saw that. Okay. GW is asking, can I do an in-kind transfer of dollars in the solo 401k of a single member LLC to a rollover IRA? Sure. Yeah. That's just what I've been talking about, where you can do a transfer from one retirement account to another of either cash or the asset. Yeah, absolutely. When it comes to the 401k, assuming you have checkbook control, you do this yourself, but you're really going through the custodian for the IRA to actually process the transfer in, because it's an IRA and you have to go through the custodian for something like that. So work with the custodian first and then have them guide you on the process, when to change the title of the asset to the new IRA LLC from the solo 401k and all that good stuff. Okay. But yeah, that's not a taxable event. Oh, good. Then I see your update, converting from Roth to solo 401k. So yeah, that was in the instructions for sure. Okay, Kim is asking, what is the transfer procedure to roll over after-tax mega backdoor Roth contribution from solo 401k Roth account to third party like Schwab Roth 401k? Well, Kior, thank you for your question. I think I'd need to understand the context of why you're wanting to go from um, your solo 401k to Schwab. Are you talking about opening a new 401k plan with Schwab? Or are you talking about just investing on the Schwab platform using your existing solo 401k funds? Because if that's what you're talking about doing, then you would just open up a non-custodial, non-prototype brokerage account at Schwab. Okay, thank you, Kier. I see your clarification. Yeah, so in our client portal, we have instructions on how to open an account, a brokerage account using the solo 401k. I will share my screen again because this is quick and important and easy. But if you go to setup, Step 2, brokerage account, bank account setup. Scroll to the bottom and just click on these are the brokerages we have the instructions for. Click on the one you want. It's called a CRA, company retirement account at Schwab, which kind of sounds like you're opening a new retirement account, but you're really not. You're just opening a brokerage account so that you can invest on their platform. They just call it a CRA, also known as pension trust. The CRA holds your plan's assets, gives you expanded investment options, et cetera. So this is a non-custodial, non-prototype account. Okay, it sort of acts like a little bit of a checking account in a way, but it's with Schwab instead of like Solera as an example. But you can use the funds, like you're even here, you're putting your plan name, the name of your solo 401k, and its tax ID number. You already have this plan. You're not creating a new one. Okay. If you already have an account with Schwab, I believe you can do this online. If you don't, I'm almost positive that you have to submit a paper application to them. Okay. And what I just said goes for all the brokerages, just they use a little bit different verbiage. Like Fidelity specifically says non-prototype account, as an example. All right. So that would be my answer to that. And then Kim is saying, for contributions to solo 401k and Form 1099-R reporting, can I complete one Form 1099-R per person, or must there be one each for the employee conversion from pre to Roth and employer 25% contribution to directly to Roth? That's a really good question, Kim. The 1099, you probably could do one 1099. I would run that question by your CPA, but you probably could do one. If you want to play it safe, do multiple. There's certainly different types of uh, conversions because of the different types of funds, but they're all in the same tax year. So you probably could just do one. You could probably get away with one. But double check with your CPA on that. And then I'm not sure. Somebody named CAN is saying it's income from a rental. Maybe that was in related to one of our live questions. Sorry, I'm not sure what that's related to. And then Kim looks like is asking another question. Can in the solo 401k, the S corp will contribute 25% of the profit this week, which is after 12/30, and then convert to Roth. Hold on one second. Okay. Felt like I was going to sneeze there for a second. Apologies. If this transfer a taxable event for 2025 or 2026? 2026. Roth conversions are taxed in the year that the conversion occurs in. Robert says, I paid for the cost of creating a self-directed IRA, and I will be rolling over the funds to an inherited IRA from an inherited to this new. Can the payment for that cost be paid to me from the newly established account for reimbursement? Not from the IRA, but from the LLC, yes. Actually, excuse me, that doesn't work. From the IRA directly, but we have to do it through the custodian. So reach out to our office, email clients, plural, at SenseFinancial.com, clients at SenseFinancial.com, and ask for the reimbursement from your IRA for the setup cost. And then we'll send you instructions to sign, and then we'll send that to the custodian, who will issue us a check. When we receive that, we will issue you a refund reimbursement for what you paid. So that is an option. It's kind of a workaround because, first of all, the plan's not set up to pay for something like that from the beginning until it's set up as a self-directed account. And second of all, you can't do this yourself through the LLC because that would be a prohibited transaction. So, all right, good question though. Looks like, okay, we have time for one last one with Bob. Can I buy out with Roth 401k converted funds an asset originally bought with 401k funds? Okay, here's the example because I'm a little confused. So thank you. My 401k plan has Roth. I have been converting 401k assets to Roth assets, Roth 401k, via 1099 payments of tax over the last 4 years. Okay. Those assets have been producing Roth 401k income that I would like to use to buy out my remaining 401k assets. No, it's got to be a conversion. You can't transact inside the plan because the plan is already the owner. Okay. It's not the types of funds that are the owner, it's the plan. So that would be like you selling a house to yourself that you already own. So no, that doesn't work. All right. Bill Kreider is asking, I got time for one last one. Thanks, Bill. How are, I assuming you're talking about RMDs, how are RMDs handled in accounts with real estate holdings but insufficient cash? Well, good question. You can do an in-kind distribution, and you can distribute the asset to yourself to satisfy an RMD, or you have to liquidate. Recommend if people are approaching age 73, a few years before that, they plan on what these RMDs are going to look like and plan accordingly. Do I want to eventually own the rental property that my 401k owns? If so, then plan on distributing a portion of that rental property to yourself each year until you are 100% owner to satisfy each annual RMD. If it's worth $100,000 and the RMD is 25 a year, approximately the value is going to change. You have to do an appraisal each year for this, but just to keep it simple, that would take 4 years at 25,000 of RMD each year, and then voila, the plan's no longer the owner. You are. Until you are 100% owner, you can have no personal use. All the same rules apply until you 100% own that real estate. So, all right. Thank you all for all the questions. Really appreciate it. Reach out to our office at clients, or rather contact at SenseFinancial.com. If you would like to talk to me directly, I'm Brett, BRETT, at SenseFinancial.com. Or you can go onto our website, SenseFinancial.com, and grab a spot on our calendar at just schedule a consultation. Thank you so much for everybody being here. Really appreciate it. Enjoyed this. Happy New Year. Again, I wish everybody here a prosperous 2026, and see you again in the near future. Take care, everybody. Thank you so much.